Hi everyone, welcome to this session with OneConnect on cutting through the hype in digital banking. This is not so much a thought leadership session as much as a common sense session that is somehow not that common. I'm no expert, but I've been fortunate to observe and work with quite a few banks. A word on OneConnect, we are a New York listed company and were originally incubated by the Ping An Group. Ping An is a major player in the retail and SME financial services space in China, with a heavy emphasis on technology. Much of what OneConnect does is built upon Ping An's own way of serving its customers and building its business. The OneConnect provides solutions in four areas. First, digital onboarding and electronic KYC solutions. Second, systems to help automate loan processes and to help manage risks in lending. Third, cloud-based core banking for new digital banks. Fourth, insurtech solutions, particularly those that help maximize life insurance agent productivity. We already serve some of the top banks in Malaysia with eKYC and lending solutions. The way we work is normally quite consultative and work closely with clients on our technology and risk solutions. We think it is important for us to understand banks and banking as a business. With that, I want to jump to the first key topic of the day, client engagement. In marriage, before an engagement, someone must propose. In banking, it is the same. Either the bank has to go out there and find a customer, or the customer has to be attracted to come and find the bank. To find the customers, banks need to go into the various spaces that customers are familiar with. The buzzword now is ecosystem, but the logic is the same as a bank trying to decide where to open a branch 50 years ago. You want to figure out the digital spaces where your customers are already in. Social media, chat or messaging apps, online shopping, car websites, news platforms. The space is even broader for SME customers. They have various systems and platforms for points of sale, for invoicing, payment gateways, payroll, accounting, inventory management, procurement, and the list goes on. Go where your customers are. Which platforms do they use? And more importantly, does your digital bank have the right flexibility and systems to connect by APIs with all these different participants in your customer's ecosystem? That's how you get to where your customers are. The second approach in engagement is less talked about but also very important. That is to attract clients to approach the bank. One successful way is to run short, intense periods of promotion, capture widespread attention, and thus driving traffic to the bank. Retailers and e-commerce firms do this very well. In the US, they have Black Friday offers that drive huge sales volumes. In China, there's the Double 11 festival where online retailers will tend to do more than 10x their normal daily volume on a single day. Ping An has done this very successfully in the past. One example is the Fortune Festival, which happens at the start of the year. During this period, Ping An aggressively launches new financial products, runs cross-sell promotions to its existing customers, and conducts joint marketing efforts with multiple third parties simultaneously. For most banks, running a promotion like this can be very difficult to do. Launching a new single product already requires effort from business, from IT, from risk, from compliance, and takes a fair bit of time. Having multiple new products launched at once only compounds the complexity. Many banks also continue to have traditional data centers and IT architectures. Having a 10x growth in traffic over a day may simply not be possible and will make any CTO nervous. However, a digital bank with the right core and origination systems in place should be able to launch multiple new products with ease. And if those systems are deployed on the cloud, temporarily scaling up the infrastructure during a promotion is a simple matter. Next, I want to touch on fraud and credit risk separately. Traditionally, banks are more sophisticated in managing credit risk than fraud risk. This is because banking is historically a very local business. The borrower walks into a branch, the bank staff meet the borrower in person, they get to know him, why he needs the money, when he can pay back. With a digital bank, banks everywhere are exposed to the latest global innovations in fraud. Seamless digital journeys also means that banks are open to fraud from anyone, anytime, and anywhere. Hence, it is also important to have a system that can protect the digital bank from losses due to fraud. So with each application or transaction that your digital bank gets, you want to be checking where it was initiated from, which country, what location. The form that was filled out, was it done very quickly in less than 5 seconds, which means a robot might hardly have done it. Is the device that created the application on a blacklist? Can any third-party data that you can tap on confirm the information being submitted? All these go a long way in helping your bank to manage fraud risk. To gauge credit risk, banks traditionally look at ability to repay based on salary, or for many small SMEs, bank statement data. But many proxies for ability to repay exist today, especially in the SME space. For example, point of sale systems can give real-time data on the shop's revenue. Utility data provide some sense of whether factories are in fact operational or just shelves with the lights on. Payroll systems provide information on what is typically a very large chunk of costs, that being salary costs. All of these can help lead to better credit decisions. After the decision is made and a loan or credit line is given, these same data sources are also useful for constantly monitoring a customer's ability to repay. These are also useful to help steer the bank. For example, if a digital bank notices weaknesses in certain key parts of its portfolio, it may choose to securitize some of that debt and reduce lending in some areas or to sunset some lending products. Now, all of these can be done without going through the very labor-intensive way of doing annual review in the way that most banks do today. In addition, some partners, such as particular payment gateways, may also have float. Digital banks can work with these partners to launch new financial products where SME repayment is directly from the float, thereby further reducing credit risk. Next, and this is somewhat ideological, digital banks should not be shy about having staff perform critical functions for customers and to have staff interact with customers where required. I'll give 2 examples. For larger SME loans, banks normally have RMs to visit the client's business premises, submit photos of the space, interview the owner, make sure that the business is really operating. In an environment where data is patchy, a fully automated decision is probably too much risk for a digital bank to take. Hence, a remote video interview solution can help. You can have your actual real-life credit staff speak directly to the real-life business owner, verify his location via GPS, ask him to turn on his rear-facing camera so that even though the credit staff is far away in the office, he can see the customers in your client's restaurant, he can see the inventory in the client's warehouse, he can see machines on the client's shop floor, right? OneConnect has a solution that goes even further and does micro-expression analysis to detect potential deceptive behavior on the part of the clients. Now, what all this combines to do is to give the digital bank similar or better levels of checks compared to the traditional bank approach, but at a much higher level of efficiency. No more long drives out to somewhere in a rural area to check on customers' factory. No more long drives out to faraway places or a long time stuck in traffic just to go and visit and interview a customer by the RM. Second example of using humans to serve customers. In a traditional bank, when customers are really stuck on their app, they call a hotline and then wait. If the hotline cannot solve it, they go to a branch. For a digital bank, the app is the bank. Customers need ways to speak to someone to get help when they get stuck. Bring on OneConnect Bank in Hong Kong, for example, offers in-app live chat, hotline to a call center, and email support. And these channels are all manned 24 hours a day. Furthermore, these live remote channels must be able to solve the client's issues remotely. There is no branch to divert the problem to. So the live support channels are even more critical for the digital bank and cannot go down. Finally, I want to talk a little bit about making money. Now, many digital banks have sought to create great customer journeys with sharp visuals and useful features such as money management tools, um, digital eKYC journeys, payments through a wide variety of channels, linkages to countless e-wallets, and so on. But the question is, what makes money? Unlike other industries such as gaming, social media, music, and movie content platforms, digital banks have to play within a highly regulated space, and each new market they enter incurs a new wave of compliance costs. Acquiring 1 million deposit accounts with wonderful features, but those which customers are unwilling to pay for and are also unwilling to put significant amounts of deposits into may simply not be the right way to go. Perhaps the bank can cross-sell services from other third-party service providers to their own bank customers. But it's likely that these third-party service providers can find cheaper ways to acquire 1 million users than to go through an organization that went through the trouble of starting a bank. I think that a digital bank still needs to figure out how to build the asset side of its balance sheet, how to give out loans, how to give out credit lines. There may be digital banks out there that don't want to play the balance sheet game, but then I guess the question is why they needed the digital bank license or bank license anyway, if they didn't plan to build a balance sheet. Now, I started this session with a bit more, tongue-in-cheek statements that looked at a few areas in digital banking. But the key takeaways are really these. In client engagement, do both things. Find your customers by going to the ecosystems where they're active, and get your customers to find you with big attention-grabbing products and promotions in short periods of time. Second, digital banks face new fraud risks, but also have new opportunities to do credit differently, manage both fraud and credit risk in new ways. Third, don't get ideological that everything must be automated with no human intervention. It is really okay to have people to ask credit questions, do the credit checks, and serve customers, and to be able to do all this remotely over digital channels. Finally, a bank cannot make money from having vast numbers of zero revenue customers. Take deposits, give more loans. If not, why get a banking license at all, right? Thank you. Thanks for paying attention. Thanks for watching this. And do reach out if you have questions or comments.